and welcome to Livewire's 2026 listed series. My name is Anna Dadich. In this series, we are focusing on the different ways investors can navigate a rapidly changing market landscape. And today I'm joined by Victor Rodriguez, Executive General Manager at Challenger Group Asset Management, to discuss private credit markets and their product, the Challenger Lifts, that looks to fill the space that bank hybrids left behind. Victor, welcome.
Thank you for having me, Anna.
Thanks for joining us. It's an interesting time to be talking about both public and private credit markets.
Certainly is.
So we might start with the headlines, and I'd love to get your observations on some of the cracks we're seeing in private credit and your interpretation of what's behind it.
Sure. There's no doubt there are cracks starting to emerge. Our view is that, for the most part, that's driven by tight valuations and sentiment, and less so today about fundamentals. And what I mean by that, in the first instance, when it comes to sentiment, we've seen a growing prevalence of retail funds and evergreen funds that have withdrawal mechanisms, and so you're starting to see, particularly on the back of the software issues and exposures there, concerns from retail investors leading to a reversal of this big, strong demand-supply dynamic where you had huge demand leading up to the last few months that overwhelmed supply, and you're starting to see the reversal of that. So that's a real sentiment thing. You've also had a lot of leverage embedded in offshore vehicles, and that can magnify valuation impacts. When demand exceeds supply, you see valuations really run hard, and now you're starting to see the reverse of that. But in terms of true credit fundamentals, in the US, for example, default rates at 4 to 5%, loss rates at 1 to 2, even the software space. We had some of the team in the US last week, and software companies today are in pretty solid position in terms of credit fundamentals. We know there's a maturity cliff coming in 28. We know that AI is a real threat to business models, but today, in terms of credit fundamentals, that's not where the concerns lie in our mind.
Vic, how does this apply domestically?
Yeah, I think there's a similar theme there. I think credit fundamentals remain reasonably solid. I'd say there's probably in our mind one exception to that, which is residential and property construction risk on the lending side. That has grown quite appreciably. It's benefited from a lower rate cycle previously, but we think there's potentially higher risks in that space starting to emerge. But other than that, we'd sort of apply the same themes as offshore.
We've also experienced a normalisation of interest rates in recent years. Where and how is this flowing through to credit markets?
Yeah, we like to talk about the punch bowl sort of being put in front of investors and then taken away and now reintroduced through lower rates. What that does tend to mean, I think, in our mind, is that you do get a lessening to some degree of underwriting standards, looser standards, and in that sense, our view is that the normalisation is one of the reasons you're going to start to see a greater differentiation between private credit managers. So, you know, the saying that a high tide lifts all boats, you know, as things start to become a little bit more pressured, we think that there'll be a greater distinction between the quality managers who are doing the underwriting, who have got the discipline, and those that are less so.
You've talked in the past about balancing between public and private markets. How are you managing your exposure?
No, that's a great question because, you know, for a lot of our funds, including the Lifts notes, we are able to invest between the two different markets. Historically, what you tend to find, and this feels like it's no different, is that public markets tend to react more quickly, particularly during risk-off periods. And so what happens is spreads in public markets widen more rapidly than you see in private, which starts to balance the ledger a bit more towards public credit. We've been overweight private, but are now starting to assess that those illiquidity premiums are compressing and that public credit is starting to represent better value and is starting to put our toe in the water more in that public space.
Income investors in Australia are facing the phasing out of hybrids, and we've seen a number of innovations looking to provide part of the solution that gap will leave. So Challenger has come to market with the Challenger IM Lifts 1 notes, which has been very well supported. Can you explain the product and what investors get exposure to?
Yeah, we're very proud of that innovative product in the marketplace. You mentioned, just as an aside, the prevalence of products that are looking to sort of replace the phasing out of the hybrid market. We've still got 35 billion of hybrids over the next few years coming to maturity. I'd say that's slightly overstated. I think there's been a lot of traditional products that are saying this is the substitute. I think what we can say about our listed note in the marketplace, which is ultimately a fixed income investment. It's not an equity investment like the LITs that are well known in the marketplace, is that it was a truly innovative solution for investors that focused on providing a clear targeted rate of return, 275 basis points above the cash benchmark, at the same time as really helping to manage the risk profile by introducing an equity layer, a buffer, a first loss buffer, that will wear the first loss of any defaults that come through the product. So that was quite innovative, and we thought, particularly in this environment of increased regulatory focus, that bringing a product that not only provides attractive income returns for investors, but manages that risk profile in a very prudent and client-friendly way, was really important, and that's the genesis of the LIFTS notes at Challenger.
Vic, we've seen a number of new listed income products come to market. How do investors compare value risk across fixed income products, and where do the Challenger notes fit in?
That is a great question. Certainly a big focus for us is educating the marketplace around the different options. I think historically, particularly in that retail space, it might be a controversial statement, but the focus has been very much on the headline rate and the historical return, and not necessarily the risk profile. In the spectrum of products out there, because of that first loss buffer and the quality of the underlying collateral as well, that we're at the more conservative end of that spectrum. And that's not to say that for investors, different types of risk return outcomes may not be optimal. It's just that as more and more products come to the retail market, a true education and understanding, not just of the headline return, whether sort of promised or targeted, but also the underlying risk profile is really, really important. And I know it's something even our regulators like ASIC very much rightly have an eye towards.
Final question, Vic. We're seeing innovation in listed fixed income products, but where do you see the gaps for further development and innovation?
In terms of gaps, I think you'd have to say that the biggest gap still in the market is the regulatory oversight. Now, the really comforting thing that I've mentioned is that ASIC has very much a focus on that. We're central to some of the discussions, both with the regulator and through industry bodies like the FSC, but understanding transparency around fees, around valuations, understanding, as I mentioned earlier, that how we're communicating, how managers are communicating the risk profile of different innovative structures to a retail audience is really the gap that is starting to narrow, thankfully, but I think there's still some work to do as we focus on prioritising outcomes for customers.
Okay, that wraps it up. Thanks, Victor, for joining me on Livewire today.
Thank you so much, Anna.
If you enjoyed that interview, give it a like and be sure to check out our YouTube channel for more listed series content.